A warm welcome to all the participants who have joined for today's session on investing through cycles. I, Akshara, remain an analyst of PMS Bazaar. Along with me, we have Mr. Jigar Mistry, who is a co-founder of Buoyant Capital. Before getting into the topic, let me brief about him. Mr. Jigar is a co-founder of Buoyant Capital with more than 20 years of experience in this industry. In prior with Buoyant, he was associated with Prabhudas Lilladher, Kotak Institutional Equities. He was also a co-founder at Buoyant Capital. And also he was the director of research at HSBC Securities. To talk about his educational qualification, he has done his BCom, ACA, as well as CFA. The major investment attribute of Buoyant Opportunity Fund lies in generating cross-cycle alpha. During the periods of extreme concentrated returns, they aim to protect the capital and look into generate large alpha during the disturbed market returns. We request the participants to put up their questions in the Q&A box, which should be taken after the PPT presentation. I also request them not to ask stock-specific questions. Over to you, sir.
Thank you, Akshara. Thank you, PMS Bazaar, for inviting me for this webinar. What I intend to do is, run you through what is it that we do and how is it that we do it. And then, cap it up with a few sort of current thoughts on how we see the market. And then we'll be very happy to take your questions. Right, so I'll move by sort of sharing a slide deck that we have. All right, so we'll start by a summary of what sort of defines Buoyant Capital, and then we'll move a little bit into detail on how we see the world and then how we operate in the world that we see. This slide basically presents the top 6 things that are important and that represents Buoyant Capital. We started the fund in June 2016. So we have about 75 months of operating history, during which time we have generated 21.2% CAGR. This is post fees and expenses, obviously, as SEBI mandates. And during this time, Kotak, Mahindra Bank, and HDFC have been our fund accounting partners, which essentially puts us in the top decile of the PMS/AIF mutual funds across time zones. So you could look at 2-year, 3-year, 5-year. I think you would find Buoyant Capital up there. The one thing I haven't sort of put up here is the fact that PMS Bazaar, in association with CRISIL, carried out the rating of the fund basis not just returns, but also the risk that the funds undertake, right? So it could be drawdown risk, liquidity risk, sector-specific risk. And we are very happy to have received a 5-star rating in that survey for a 3-year period ending December 2021. So that's largely the output. Let me focus a lot more on sort of what goes into the input part of it. The first, as always the case, is the team. Buoyant is owned and run by 3 of us. All 3 of us are chartered accountants with 20 plus years of experience. Viral is also from IIM Ahmedabad, basically used to run SL Mutual Fund, and before that was the CIO of Reliance Life Insurance. He used to handle in excess of $3 billion in debt and equity, around 22,000 crores. I am a CA and a CFA from AIMR US. CA and a CFA from AIMR US. I was last director of research for HSBC Bank, which is typically a sell-side job. So my job was to advise foreign institutions on how and where to invest in India. And before that, I was with Kotak, which was then a JV with Goldman Sachs. And Sachin is also a CA and a CW, and was last with Reliance Mutual Fund. Now, there is a distinction in the way we are structured versus what a lot of our peers would be structured, in that most of the funds sort of tend to have one fund manager and a sort of team reporting into them. Our experience has been that with that sort of a scenario, we don't realize that when we graduate from being analysts to fund managers, we carry a large familiarity bias, right? If I am someone who has always invested in consumption themes, and then when the consumption theme goes out of favor and commodity theme, for example, picks up, then you see that most of those funds tend to underperform dramatically. That problem we have tried to resolve by, sort of distributing the fund between three of us. All three of us are sector specialists. So, I have looked at banking and finance, utilities, global commodities. Viral has looked at IT, FMCG, retailing, Sachin at auto, engineering, etc. So as far as it relates to the sectors that we track, we become the fund managers. And you will see in the later part of the presentation how that has essentially helped the fund sort of operate through cycles and perform irrespective of where the sector cycles are. And let me assure you that even if you don't realize that there are a lot of sector cycles, the data will show that that's dramatic. The second point is in terms of framework, and I think this is important as well, because if you look at sort of where the majority of today's discourse in the market is, then essentially it sort of lies on the curve like this, that let's say we are looking at time on x-axis and value on y-axis, and you essentially are able to identify a company that, let's say, is growing at 15% CAGR, right? This could be a measure of value, a free cash flow growth, or a earnings per share growth. Now, I think a lot of people and investors start believing that once you identify a business like that, all you have to do is to stay invested. That sort of works on occasions, but not always. So what tends to happen is that typically a stock price would essentially, sort of start outpricing the fundamental value. And at a certain point, investors realize that we are paying a lot for the value that the stock is delivering. And this stock sort of tends to flatline before it catches up to the share price, to the fundamental value of the company again. This period of time can very easily be 7, 8, 10 years. We have seen periods in excess of 12, 15 years, and one case where the stock sort of flatlined for 19 years when the earnings were growing. And this sort of stock behavior introduces cycles in investing, right? You look at very long periods of time, say from time here to time here, you might think like the stock performance and fundamental value growth are similar, but essentially there are a lot of cycles that exist, which is the mainstay of what it is that we do. We identify these cycles and we invest through them. That allows us to be aggressive on occasions and defensive on other occasions. I hope that once I complete the presentation, this will be a lot clearer. But we believe if you sort of invest in this fashion, then you are running the portfolio with a much lower volatility and much superior returns, as sort of we will demonstrate. The second last point is in terms of model portfolios and our sort of complete disregard for those. Because when you are running a portfolio management service, unlike a mutual fund or an AIF, where you are, at any time you give the money, you essentially are invested on that day. Unlike that, a PMS affords the opportunity to the manager to run the portfolio in a unique fashion. You might be owning 20 stocks in your portfolio, but not all 20 are buys the day, you give the money to your portfolio manager. What needs to happen is that, when you give the money, if, a few businesses make sense to invest today, you invest in them today. If, a few businesses don't make sense, you wait for it to make sense, at a later point in time. However, most of, investors end up, running the portfolio just on a sheet of paper and investing every day the money is received, which we don't think is the right way to invest. To that end, we set up the working with an IT company when we started. And today it's a very robust system, which actually allows us to treat each and every portfolio as if that is the only portfolio we are running. And on occasions, we have been aggressive, we have invested in about 2 weeks. We have been defensive. We have invested in about 8 months. If here we essentially take the question of where to invest away, here we take the question of when to invest away from the end investors. The last point is in terms of skin in the game, and this is a topic which is very close to our heart. If essentially, we are asking you to invest in a fund that we run, then ideally we should also be investing through these funds. We don't see a lot of investors end up doing that. Obviously, we, as in the directors and Buoyant Capital as a company itself, invests only through Buoyant funds. As we speak, actually, as of end of last month, the value of this investment stood at something like 37 odd crores. And this is a very important point because it signifies the conviction that the fund manager has in the schemes that they run. Ideally, we believe we should be running just one scheme and not confuse the investors as to whether you should invest in large cap or small cap or pharma funds or sectoral funds. If all those decisions you can take away from them and run it as one fund where money can come in, and then you take the question of where to invest away and when to invest away from the investors, then that tends to generate the largest sort of satisfaction among investors over a long period of time. Right. So these are the 5 or 6 things that sort of define Buoyant Capital. I'll now come to how we see the world and how we invest in the world that we see. Right. So the central thought process is that although human minds think in linear terms, not everything sort of happen, and anything that is of consequence always happens in cycle. Right. Take the case in point of indices here. So if you look at over 20 years. That you look at over 20 years, you might see that the Sensex has generated 17% CAGR, the small case index has generated over 19-year CAGR, right? So April 2003 to July 2022. However, when you sort of zoom, and it might make somebody sort of come to the conclusion it doesn't matter where you invest, right? All indices give similar returns. But when you sort of zoom in into a period like this, right? December 17 to March 20, when the large cap index was down 12%, which is Sensex, and the small cap index was down 50%, the market discourse suddenly sort of starts changing into the belief that, in India, there are only this 15, 20 top quality companies that one should invest in, and everything else, you should just ignore. FIIs will invest only in these names, and domestic investors know that FII will only invest here, and therefore this is the place to invest. And the largest amount of alternative money got collected in this time that invests in such businesses. But when the sort of sector turns around, the small cap index sort of completely removes the underperformance in a matter of few months, right? So ideally, instead of chasing what has been the most recent performance, typically small cap fund managers are rock stars here and large cap fund managers are rock stars here. But what we do at Buoyant is basically see them as cycles and operate accordingly. So in either periods, you not really find Buoyant on top of charts. But when you combine these periods, Buoyant really emerges as among the top contenders. Now, this is also very interesting because like we looked at it for different indices, we are looking at different sectors here. So during this sort of COVID downturn, FMCG was the best performing index and metals was the worst. And when sort of it picked up, the exact opposite happened. This is recent in our memory. We know something like this had happened, right? But you look at the previous cycle, right? This started from somewhere around, I would say, September 14 and lasted almost until September 19. So for this 5 years, if the market fell, consumption was still the best performing index. When the markets rose, consumption again became the best performing index. So we sort of generalize this to believe that market goes up or down, consumption facing businesses are the best businesses. It doesn't matter if you pay 50p for them or 100p for them. These are businesses with moats. We forget to sort of look at this from the right perspective, that during this time, your commodity price inflation was near zero. In fact, commodity prices fell almost 25% during this time. Crude prices fell during this time, and therefore there was no cost inflation that needed to be passed on. However, when cost inflation came through during this cycle, you realize that this consumption stops being as a very attractive theme, and many of the funds that concentrated only in this theme tend to underperform. And this is not new. We had the same thing during 2000 to 2008 when capital goods was in the similar space. But again, when the market peaked here, it took 11 years, right, for the index to come back to the same level. So not just market caps operate in cycle, different sectors operate in cycle. And this is interesting, right? Because until very recently, we didn't think that IT is a cyclical sector. So we have removed that part, just look at the peak of the cycle. But even then, when you look at the last 2 decades, IT has underperformed for 1 decade out of it. FMCG has underperformed for 1 decade out of it, right? Automobiles is underperforming for the last decade. So essentially, not just cyclical sectors go through these cycles, even sectors which we think are structural, they undergo cycles as well. The last part is in terms of stocks, and I started the discussion by sort of showing this chart where you see stocks sort of flatline, and this is our attempt at highlighting a few cases where we have seen this flatlining happen. uh, we have taken 4 examples, but I very easily have another 20-25 to go by. But look at this, top to our international companies, bottom to our Indian companies. Take Coca-Cola, for example, right? Warren Buffett bought it in 88. For the next decade, the stock was like a stock market darling, right? It went up 10x in 10 times. However, Coca-Cola was still a great company at that point in time. But for the next 19 years, when the EPS doubled, the stock returns were essentially zero, right? Because as consumers, we know what we pay for, the stuff that we buy is important. But as investors, we often tend to forget that and, start believing in narratives and theses, which essentially leads to this performance. IBM, 12 years, EPS tripled, stock returns zero. The bottom two are Indian companies. Colgate, 15 years, EPS quadrupled, stock return is still zero. Right. So now imagine this situation that if you are buying Colgate here, and then you will see your EPS go up 4x, but the stock price is going nowhere. And that is essentially following this phenomena. Right. So if everything is operating in cycles, the way we think we should operate is also invest through cycles. Now, how can you sort of practice doing that? What we end up doing is that we break our investment sort of universe into two parts. One that we think is core to our investment, and other that what we call is satellite. Now, core, I don't need to explain a lot here because this is where I think almost 80 to 90% of the market is focusing, which is identifying what is a great company, right? You speak to any investor, the majority of the discussion goes around building up what is a great business, what is a great company. We hardly, if ever, come down to talking about what is a great investment. A good company may be a great investment, but there are times when it is not a great investment. Here we are talking about core businesses, which are essentially predictable cash flows. They have leadership position, and essentially they are generating so much cash that they don't need it for growth, and therefore have a very well-defined reinvestment plan. These are important businesses. They should always be part of the portfolio. Where we differ from the street is in the belief system that this is one part of the portfolio, not the be all end all of investing. We also believe that satellite is an important part of where we should look at, which comprises of stuff like cyclicals, turnaround, and value. Right now, what are cyclicals? Today we are even open to talking about commodity businesses like metals or cement, etc. But you look back, say, if you are in 2019 and you stretch back to 20 years, right? So from 99 to 2019, something like a Tata Steel, for example, at the start of 99, the price was 275. At the end of 2019, it was still 275. Right? And investors started assuming that, look, this is a sector that doesn't really matter. But when the cycle turned around, the stock went up to 1,000 today. That's recent, so we are open to listening about it. But even during those 20 years when the start and end date did matter, your Tata Steel stock was below 300 on 3 separate occasions, and it was above 800 on 3 separate occasions. So instead of asking a question as to whether this is a good or a bad company, we should actually be asking the question whether our risk matrices can be strong enough to be there for part of the ride, right? You obviously cannot buy at the bottom and sell at the top, but even if you are there for part of the ride, which sort of we will demonstrate what we have done, you tend to generate much superlative returns. And it's not once you start seeing this as cycles, you will see metals as a 2-3 year cycle, or CV as a 5-6 year cycle, or NBFCs other than for a 7-8 year cycle. There are a few exceptions, obviously, in all of them, but we are talking generically speaking, most of them is cyclical. The second is turnaround. And again, the debate here boils down to good company, bad company versus a good investment or a bad investment. So when sort of Reliance Jio came in, There were 13 telecom players. When Jio was done with its freebie offer, there were only three. Right now, at the peak of that disruption, if you looked at Bharti, it would appear as if you are essentially looking at a company that is losing customers, that is losing, net profits, reporting negative cash flows. So, from any perspective, it was a very bad company. The other question you should have been asking is that there is no country in the world with fewer than three telecom players. And in India, even if there are only two, Bharti would be the second, right? So your questioning should have moved away from good company or a bad company to whether it will be a two-player or a three-player market. And once it was established that it will be a three-player market, the stock sort of went up 4x from its bottom. The last part here is value. And I think this is also important because, in India, typically we are so enamored by leadership that we tend to pay a huge multiple to leadership companies. Like you take the example of, say, HDFC Life versus, say, Max Financial. Right? HDFC Group is a great group. They have phenomenally run the bank very well. But as a life insurer, we find, its numbers are pretty similar to second or third, basically, candidates. But HDFC Life was trading at 4 times price to embedded value. And Max Financial, which in some counts, I would say is if you look at the agency force, you look at the product palette, par versus non-par, or if you just look at the return ratios or VNB margins, they are very, very similar players. But when one was trading at 4x, other was trading below 1 times, right? And eventually we have seen that this valuations catch up, right? If you think it happens only in insurance, think what's happened over the last 3 years with, say, ICICI Bank versus HDFC Bank, right? So to summarize this sheet, basically core is where majority of the focus of the investors lie. And we think that is an important part of investment. But the market sort of totally looks beyond satellite, and we think there is a reasonable opportunity here. Now, having defined what is core and satellite, and this sheet might sound extremely simplistic, but let me assure you that the proof of the pudding is in actually executing this. Right? So in terms of strategy, the theory is very simple. When we are aggressive, the idea is to generate superior returns, at which point satellite is a larger part of the portfolio compared to core. And having generated superior return, we want to protect the capital, at which point we turn defensive. Satellite sort of goes down, core goes up. And as I said, might look very simplistic. So let me come down to how we have executed. So this is essential PMS track record. This is an important slide, so allow me a minute to explain this. The gray bar here is the benchmark, which for us is BSE 100, and the red bar is Buoyant Capital, right? So since inception, which is 75 months, the index has invested 76% into sectors that we think are core and has generated 105% returns, right? In comparison, Buoyant has invested 42% capital. So we have invested slightly more than half. But when you look at returns, when you look at these two slides, at half the capital, we are generating a much superior return, because within core, we are able to identify the sectors that needs to be invested in, and within which sector, which companies make the cut. So obviously, like to like, there is a superlative performance here. But the real sort of returns is in the satellite space. So investors just look at this part, right? You invest a large part into satellite, which is cyclical turnaround and value. You don't generate any return. Well, the index doesn't generate any return. But if done right, we have invested 57% capital and invested and have received 100%. So when you compare these returns, these are truly sort of well laid out returns. Within cyclicals at 2.5 times capital, we are at 4.7 times returns. Turnaround, we are, I think, 3.5 times capital. The index is hardly generating anything. We are generating 35%. The other way to look at this is basically, look at time split returns. So essentially, we started the fund in June 2016. We ran it aggressive till October, during which time, Sensex was something like 20% return, but we generated 63% return. Now, in October, we became defensive. The long-term capital gains budget came at the end of Jan. The broader market was down, and we ran a defensive portfolio till Feb 19. The Sensex was driven up by five, large names. Those five accounted for more than 100% of index return. But our idea was to protect the capital, which we did. Then Feb 19, we became aggressive again, ran it like that till August 2021. The fund did almost in line with best in class. We basically generated 72% return. And then we have turned defensive again, at which point in time, the idea is to protect this number, not look at this outperformance, but that has happened, which is hearty to note, which sort of summarizes into this sort of numbers. So this is a 1 year, 2 year, 3 year, 5 year since inception returns. BSE 120, we are cumulatively at something like 230, so roughly 2x the market return post fees and expenses. Now, one of the, this slide, again, I might want to talk a little more about it because, some part of, communication gets lost in translation. What I mean by that is that there is often a time when there is a difference between the fund returns and the sort of investor returns. Investors might come in at the wrong time, might get out at the wrong time. They might invest in sector cycles which are not playing out, or basically, your market cap cycles which are not playing out. And therefore, they leave with a lot of grievances at the end. It has been our endeavor essentially to reduce that difference between, the fund returns and investor return. And we think communication plays a large part in that. To that end, basically, we sort of, for one, we have been totally transparent. So we put out our portfolios out on a daily basis to all investors. Essentially, everything that we do every day can be looked through in the login. But more importantly, we write on a weekly basis. That's carried in the Economic Times now. Just this afternoon, we have released our 100th article. And here we talk about, different sectors at depth. So we would discuss as to why new age tech companies, say, for example, in September 2021, why the new age tech companies are essentially, not really a play on Indian consumerism, but they are a play on US 10-year treasury rate. And, 100 articles, so we have looked at several sort of sectors and investing philosophies in detail. If you go to our website today, we'll find under memos one sort of letter where we have compiled our best 20 articles. Maybe you can start from there. But this, communicates to our investors and generally people who are sort of keen to read as to how do we think about different sector and investment philosophies, which is essentially everything other than how we see the markets. And how we see the markets is what we cover in fact sheets. That's again put up on the basically website. And last but not the least, all our media interviews are documented and put up on our website. It's easy to get carried away when the market is good. You tend to talk a lot on the positive side and vice versa. You go back and check, you'll find a reasonably good sort of openness in terms of how we communicate, right? So essentially that to its end, the PMS, all PMSs are essentially a stock selection engine. We think, we might not be the largest team on record, but essentially we are among the most senior decision-making teams, which can also be seen through the, core sector returns that we demonstrated. Most of our peers essentially would want to end here, but we essentially believe that we can do slightly better. Since inception, we have run one fund, right? If you think large caps make more sense, we can take, increase the exposure to large caps here. If we think small caps make more sense, we can increase exposure here. We can be aggressive or defensive. And therefore, you are not left with the decision on, what market cycle we should track, what sector cycle we should track. We are very happy to do that for you. And not just do that for you, essentially, we put all our money in this one fund, and that sort of aligns your interest and ours. But that's not where it ends. We also sort of believe in a better execution. So as we said, if here we are sort of taking the question of where to invest away, we are also taking the question of when to invest away. So when we are aggressive, we invest fairly quickly. When we are defensive, we take a lot of time. and therefore, you at your end don't really have to sort of take that decision. Lastly, I will sort of, being cognizant of time, I will, broadly cover one part on why alternatives make a lot more sense, and Buoyant is part of that. Obviously, we are all SEBI registered entities. We have custodians, and therefore there is a reasonable protection of capital as to how we operate. But also, we don't really have an institutional imperative. When we are running, we are looking at just the investors' interest and not other any group interest, with a lot of traditional investment engines have come to realize. And essentially, a smaller size allows us, to sort of be truly nimble and multi-cap oriented. If you're running a 10,000 crore fund or a 20,000 crore fund and you want to buy 8% or 9% of your fund into a stock, there are very limited places where you can do that. And therefore, small size with a reasonably strong track record is a very, very valid alternative for all the investments. Also, communications are better, right? So as I said, we communicate through several means, and therefore that allows the investors to be totally aware as to what we are executing. And lastly, there is no index hugging, right? So typically, if you are not running a very large fund, you're free to choose it to run it in a truly multi-cap fashion. With this sort of, we are also getting into AIFs. Whereas PMS has its benefits, AIF also have a few benefits of its own. Unlike a lot of AIFs today, the AIF that we are launching is a Cat 3 open-ended AIF. We don't have any lock-ins, we don't have a close-up period. Any investors who joins in basically is free to withdraw at any point in time. The returns for AIF are post-tax basis, so that will be the entry or exits will be timed to once a month, but there are no lock-ins. Also, AIFs allow us to be called as the qualified institution participants. Will be able to participate in OFS, QIPs, IPOs. Thirdly, the taxation is a post-tax distribution, so it's much less cumbersome vis-a-vis a PMS bookkeeping. And lastly, it is in the trust structure, and therefore, basically, the shares are held in the trust and not in your own name. So a few people have compliance restrictions in investing via PMS, but obviously all those investors will find AIF basically a lot more suitable. For us, it is the extension of the strategy that we are running, so it's the exact same thing. Right, so I think this is what I wanted to share vis-a-vis sort of how it is that we do. Should I sort of run you through, Akshara, what we see in the markets per se today, or you want to take questions? How do you want to do that?
Because along with the questions, you can take us to the market, sir. Because
okay.
While asking questions, you can connect it with the market and can go forward with that.
All right.
So thank you. I need to thank you for the insightful webinar and PPT presentation as well. We have got few good questions to ask. Let me start off with the main thing, which is the talk of the town, about the inflation rates and all going up. All around the world, the central banks are hawkish about the fighting inflation with rate hikes. The recent Fed rate hike was about 75 base points, which pushed our RBI also to raise our interest rate by 50 points, basis points. So how do you see Indian economy moving forward? What's your point of view on it?
Okay, Akshara, thank you for that. So I think let me sort of start through how we see, the Fed acting, the recent sort of earlier during the week, the BOE that interacted, and how we bring it down to India. Now, the Fed sort of, before I would say Jackson Hole Symposium, there were two alternative points of view. The two alternative points of view were that obviously inflation is high in the US, and historically it has not been as high as we see it right now. There is a possibility that if push comes to shove, the Fed might back off, might continue to learn and live with a 4% inflation versus a 2% target. And therefore, the rate increases that they are taking right now is just the dry powder to cut rates when the economy goes into a recession. The other point of view was that, look, Fed is very serious about what it's trying to communicate, and they will go down to 2% inflation target. And beyond that, it doesn't matter, right? Economy can go in a recession, demand can get crushed, but Fed will continue to sort of push it down. There was, when the market recovered before Jackson Hole, this was a very eloquent alternative as being presented. But with the Jackson Hole speech, he essentially killed option number one, which was reiterated in the latest meeting, where he said, when he sat down and said, look, it's a continuation of Jackson Hole. And then he was asked question as to whether, the mortgage rates are going up, that's creating a problem, to which he answered, and this is sort of my summary, not his verbatim, but to which he answered that, look, we don't really care. You have to learn to live with short-term pain, because otherwise inflation expectations seep in. That's one part of it. Clearly, we are going to crush the economy so that the inflation rate comes down to 2%. The other part is, and I think this question I don't see a lot of investors asking, is, if quantitative tightening it becomes a reality. Now, by quantitative tightening, you look at the central bank's balance sheet, right? If you look at the Federal Reserve's balance sheet, it has continued to expand since 1994. Yes, in between they've taken rate increases, but the balance sheet value has not come down. That has started coming down today. So over the course of the last 27, 28 years, when all of us sort of developed our investing acumen, we have continued to live with this, expanded sort of gush of liquidity pushing asset prices higher. And therefore, all you had to do is to identify a great company and sit tight. And, with the valuations continuing to expand, even if you made a mistake, it would only be, a time mistake. So we invented terms like time correction, etc. But now, if your balance sheet is going to shrink, which I think Powell was very categorical in saying they want to do that, then our estimate is that your cycles will start getting a lot shorter. And therefore, you will have those quick, today commodities are doing well, tomorrow suddenly people develop a fear and they're not doing well. So cycles that we saw over the last 2 decades might get shorter. And equities as an asset class, one needs to sort of keep evaluating on where to get invested within the equities asset class. Coming down to, there was a breather earlier this week when, Bank of England essentially said that we would purchase a lot of sort of bonds, very high duration, 30-year-old gilts. And I think the street mistook it to mean that BOE has pivoted, when in fact, they were only trying to do something to calm the market. Now, in very, very basic terms, think of, let's say if I am in a job and I'm given a defined benefit plan, which is that when I retire, I'll be given, say, 200 rupees, $200,000 or whatever that number is. So far in my working journey, I have invested something, I have sort of saved and put in that defined benefit plan, something like $100. Now, those $100 are lying into a held to maturity bond, and therefore that's completely locked in. But because the pension company has to pay me 200 rupees, it will have to take a decision on how it will invest the other 100 rupees or 50 rupees that I'm going to pay, and how they will invest that, because that they need a fixed rate return. All they did was that they swapped a fixed rate return. They gave a floating rate and bought a fixed rate return, which resulted in some sort of leverage or apparent leverage on the books. So when the longer dated yields corrected, they were given as collateral to the banks which wrote those swaps. And when they fell, the entire system went for a teasing. All Bank of England came and did was that they say, okay, let's not unwind this disorderly. We will support it. And therefore, that was a very temporary relief. It does not mean that the Fed is going to pivot. It does not even mean Bank of England is going to pivot. It's just a temporary release to manage the problem that we had. In consonance with that, India basically today also raised repo by 50 basis points. Now, India is not undergoing an issue like the rest of the world. Our economy is not superheated or anything, but you have lost something like $90 billion in reserves over the course of a few months. And the RBI is aware of that. They are very keen to protect the currency, which is likely to go to 82 and above. In that scenario, they'll have to keep increasing the interest rates with the hope that the FPI flows, at least on the debt side, are not hugely negative. So far, the central banks are not really sort of decoupled as one you would wish. Even if the economy is not heating up, India will have to raise interest rates. I hope I have answered that question.
Yeah, yes, completely. So moving on to the next question. In a volatile time like this, small and mid caps by nature tend to remain volatile and fall more. In your portfolio, how do you control this volatility and safeguard your portfolio? And on the basis, how do you relocate your small and mid cap during this volatility time?
Perfect. So again, an interesting question. See, as I sort of demonstrated in that slide, small and mid cap essentially have cycles of their own, right? And therefore, the first thing one need to do is not get carried away, right? All of us in 2017 were looking for the next multi-bagger, when ideally we should be looking at a best dividend yield name, right? And in peak of COVID, we were looking at the best dividend name, where we should ideally have been looking for the next multi-bagger, and that cycle continues. I think the way we address this is by looking at what we pay, for the businesses we buy. So unlike sort of the earnings and price to earning ratio, etc., that becomes a little difficult because eventually P is a state of mind, right? You cannot have a number which is justified in terms of a mathematical formula. When we buy a business, we essentially, let's say if you're buying Hindustan Unilever, right? And we approach it with the assumption that if I buy this business and I'm never allowed to sell it, then what sort of assumptions in free cash flow do I have to make to justify my investment and returns, right? If you're forced to justify that your free cash flow should grow at 20% CAGR for the first 10 years and then 10% till perpetuity, and those sort of things sort of doesn't really make sense because the penetration of Hindustan Unilever products is already so high, and therefore these valuations don't make sense. That's when you should start thinking about whether you should be buying those businesses or not. The second point I would highlight is that, see, volatility is a fact of equity markets, right? There is a difference between, although we sort of equate volatility with risks, theoretically, volatility may not be risk because nothing sort of, as we saw, go up in one sort of straight shot, right? The best performing stocks have had a 40-50% drawdown. So instead of sort of getting perturbed by volatility, if you sort of understand the value of the business you are buying, volatility actually can be a very good friend of yours, right? You can take advantages of, when the market is very exuberant, and then take also the advantages when market is very depressed in terms of how they view this business, and get your positions curated accordingly.
Thank you. With said that, I want to take a question from Madan Mohan. He has asked this. While I agree that investing through cycles is a great idea, but every fund manager keep insisting that the timing is not worth it as you lose out in long run. How do you react to this philosophy?
Sure, thank you. Thank you for that question. And I think there is a subtle distinction in timing the market versus investing through cycles, right? Timing the market is whether you sort of go in and out of businesses, whether you go in and out of markets. And I am with you in terms of that you lose the 10 best days of the market, your returns will be substantially lower. Our sort of essential fight is against the belief system that once you have identified a great company, you start believing that that is a great investment at all points in time, right? People often give the example, and we have a lot of followers who just blindly follow Warren Buffett. But you look at his investment style, and that's not, the followers, what they do is not what Warren Buffett does. I'll give you a critical example. We looked at Coca-Cola here, right? Warren Buffett first bought it in 1988. He increased his position in 89 and bought a slight quantity, which was the last quantity he ever bought in 92. right? Coca-Cola still, I think, is in its top three holdings. It could be the second highest holding, but I could be mistaken there, but certainly top three. But after 92, even when Coca-Cola corrected, he never put in the money. Unlike you and me, who has 100% as a finite source of money that we can invest, Berkshire Hathaway keeps getting free cash flows every sort of year, right? But he chose not to invest in Coca-Cola after 92, despite stock correcting 50% from the top. So my argument very simply is that when we identify a company as great company, what do? We essentially say, okay, we bought it at 100, stock is at 150, we bought it again at 150. If the stock is at 500, we again bought it at 500, right? Unlike practitioners of Warren Buffett, we sort of take that logic to the extreme and make it as if that great company is a great investment at all points in time. It's not. Right, as a proponent of, let's say, I believe iOS offers better privacy than Android, right? To sort of make it a very consumer-specific analogy. Now, I have to pay more for that privacy. I am happier paying, say, 20% higher than what Android is selling at. If iPhone starts pricing its product at, say, 10 times the price of Android, are you still going to pay it? I certainly am not. Somebody values their privacy way higher than I do, and then maybe they can buy. But a large majority of people are not consumers of iPhone at 10x the price of Android. But as consumers, we know that. As investors, we tend to forget and start believing that a good company is always a great investment. And because some section of the people believe in that thesis, these cycles get generated, which we can take benefit of. That I'm not for one instance suggesting that when the market is up, you come in, and then when it's down, you go down. In fact, personally, all three of us are 100% equity investors at 100% of the times, right? So certainly not suggesting time in the market.
Okay, thank you. Thank you for that. You said you're not going to time the market and all. But with the supply chain disruptions and uncertainty in China, which all of us know, can Indian chemical manufacturers can be considered as an emerging incredible alternative, because they're choosing an other alternative other than China for manufacturing. So how bullish are you on the sector? Chemical manufacturing.
So I think, see, China plus one is an interesting theme. And for that, you sort of look at where China comes from. Like, for example, and not just China, in the late 90s, your Asian tigers, Indonesia, Thailand, etc., went through the same route, right? You sort of develop and, your labor cost is low. So you become the manufacturing hub of the world, which gives you the control over your current account because you are largely exporting and not importing as much, which gives you the control over your current account, and therefore your standard of living across the economy increases. And then you start focusing on everything else. So like in 70s, what Japan did, in late 90s, what Asian tigers did, in 2002, what China is doing. China eventually comes out of becoming the manufacturing hub of the world because labor now starts getting a lot more expensive. You also start seeing, your possible scenarios where pollution and ESG concerns take over, and therefore they said that, look, we are no longer interested in doing this. We want to make the next hypersonic missile. In fact, they have beaten NASA to that. We want to sort of build planes. We want to build, like high-tech bullet trains, for example. And therefore, India is, on the contrary, for a $2,500 per capita GDP, services form a majority part with very little manufacturing, right? So we have the opportunity here. The government is focusing on PLI. So there would be a lot of sectors in the China plus one zone, or maybe EU plus one zone also now, where India will be able to take benefit of it, not just bulk chemicals, but also, say, textiles, some other, backwardation. What the government did a fairly decent job here. You start with the mobile phones, right? Then you go a step back and you say, okay, just start assembly here. Right? Then you would go a step back and say, okay, we'll invite in a Chinese company and an Indian company to set up a fab manufacturing unit in Gujarat or Maharashtra. So I think they're taking those smaller steps in order to make sure that manufacturing becomes an important mainstay of India. and that has its opportunities. So yeah, chemicals is interesting, textiles is interesting, but more importantly, this theme needs to emerge more viably, and a lot more sectors will get added to that.
Thank you for that. Moving on to your strategy thing, your satellite portfolio is a cyclic one. How was your stock selection done there, and how do you see it in next 2, 3, 5 years of it?
Right. So yeah, satellite selection, as I said, we've broken down into three parts: cyclical, turnaround, and value. And there are times. So when we typically go defensive, like we did in August 2021, at the peak of COVID, we were something like 70% small and mid caps, right? Because the small and people wanted to just buy IT, FMCG, pharma, right? Those three sectors were, COVID mainstays. And the rest of the market was available for a song, frankly, right? So we could buy businesses at 1.5 time normalized earnings. And when the cycle recovered, you sort of generated a lot of money into them. When we started turning defensive, however, in August 21, we focused a lot more into large caps. We focused a lot more onto core. So large caps, at the peak were almost 70% of our portfolio. We think, as we see the market today, right? See, what does it boil down to? It essentially boils down to the fact the inflation in the US has still not come down, right? And one might wonder that, crude is down, commodity prices have been crashed, but the inflation now is being driven by sort of the services side. Right, in the previous administration, they created sort of strictures on visas and immigration in general. And a lot of people post-COVID are not really that keen on working that hard, right? So prices have gone up for people and employment is refusing to come down. And that might force Fed to continue to be a little restrictive. We believe India may not be that decoupled, right? If I took you back in August 2021 and made this prediction that over the next year, Nasdaq will be down 20%, Dow will be down 10%, crude will be higher by $35, FIs will withdraw $40 billion. At the end of 1 year, what is the chance that Indian market will be positive, right? I'm sure you would have said 0%, but that's what has transpired, right? The decoupling has happened to some extent because post-COVID, Indian investors have realized that equity is a serious asset class, right? It's not a gambling casino where you come in and get out. SIP, is generating very serious amounts of money now. So domestic investors sort of pulled the first leg of the rally through. And then post-Russia-Ukraine conflict, FI investors realized that there aren't a lot of places where we can invest, right? Russia, China, Hong Kong is roughly 50% of flows. So in that scenario, you are not sort of likely to see a place where, India doesn't get a lot of flows. So yes, India will be relatively better given the flow situation, but I would caution investors from using flow as an investment strategy, right? Because you cannot predict flows. And in the short term, certainly you can't predict flows. So as long as your fundamentals are weak, you should use this opportunity to, hold large caps. You should use this opportunity to own more core stocks. And eventually we'll be presented with a time when there is exasperation in the market, when we get into small and mid caps, when we get into those multi-bagger ideas.
Thank you. With this, with said that, IT sector is underperforming since the global recession happening. So it has fallen around 20-25%. So do you see this as a recovery, or do you see people should get out from the stock selection, or you feel this is something which is basic and people should enter now? Like what do you feel about?
Sorry, please complete.
No, what do you feel about IT sector?
Yeah, so see, I think India does not have technology companies, right? What we have is IT services. Post-COVID, Nasdaq started rocking because Nasdaq has tech businesses. What is the difference? A company like Zoom can, in theory, not in theory, actually it did happen, can increase its revenue 5x any given year. Right? The smallest of IT services companies if they have guided for 15% growth, might have to move heaven and earth if they want to report a 20% growth, right? Because it is backed by sort of, you have to hire those many number of people, you have to sort of let those many number of people deliver, which means you have to have trained 1.2 times the people, which means you have to have hired 1.5 times the people. It's not an easy task, right? So in theory, we always believed that the IT companies should, the multiples of Indian IT service companies should not have re-rated with the increase in Nasdaq companies. But the market being as it is, they did get re-rated, and now when the Nasdaq is falling, these companies are falling in line with that. Now, if you talk to most of these IT companies, they're still not happy with regards to the business they are getting or margins that is being contracting. Valuations have come down to average levels, but they still don't offer like a great deal, right? So with the sector having corrected as much as it has, we don't really have a large exposure beyond one or two names. But again, in percentage terms, it's fairly fair. I think it would be the largest underweight sector that we have. But I think we'll still wait for a few sort of months or better valuations to get positioned in those names.
Thank you, sir, for that. But the last question that I want to ask you is that since inception, your opportunities portfolio has beaten its benchmark around at almost 8% each year. How do you see it, and how do you pursue it, sir?
Right. So I think, it's been good going so far. We believe that, the Indian equity markets do offer a great ray of hope, right? Once the inflation issues at the Fed subside, we are at the cusp of probably, among the best decades that India has. Your labor force participation is increasing. A lot of young people are joining the workforce. Your government is taking steps to basically ensure some manufacturing comes through. The economy is getting a lot more organized, right? 2015, the asset quality review of the banks, 2016 demon, 2017 GST, 2018 IL&FS crisis, and 2 rounds of pandemic, 2020 and 2021. The bank's balance sheets are cleanest, corporate balance sheets are deleveraged. Flow-wise, India is yet to see the highest amount of flows sort of come through, because equity as a percent of household saving is still only sub 5%. So we are likely to see phenomenal sort of decade to come. We just have to make sure that we don't get caught up in the wrong cycle, and therefore the sort of caution at the start of it. We are hopeful that we'll continue to beat the indices as well we have done. But even regardless, buoyant or not buoyant, or alternatives or not alternatives, I think equity as a mainstay is going to be a very important asset class to be invested in for the next decade.
Thank you, sir. So with that, we have just come to the end of the session. I would thank all the participants as well who were with us all this while patiently, and thank you for answering all the questions, sir. And getting us through the market outlook as well as your portfolio. And thank you. Have a great Friday.